Hey guys and girls, welcome back to another video. So it seems like we're in for a bit of a volatile week coming up. So last week saw the Dow with all the blue chips in it fall by 1.1%. We saw the S&P go down 0.6% after a 2-week win streak, and we saw the Nasdaq fall by 0.7%. However, the futures are currently ticking up now before the market opens in a few hours in the States. And let's take a few minutes to understand why and what are the key considerations for this week. So from Thursday to Saturday, we have the virtual meeting of the FOMC called Jackson Hole. It's the Jackson Hole Symposium. And what investors are looking to hear is some sort of clarity or guidance or telegraphing from Jerome Powell around their plans for bond tapering. Now, we spoke about this at length in other videos. If you haven't seen those videos, please do go check them out, as it will help you understand this whole process a little bit better. Now, there's a bit of a mixed feelings going on at the moment. Let's take a look at this quick diagram. So, if you imagine you're Jerome Powell, you're in this bit of a delicate situation of balancing whether to start tapering or not. And on the left-hand side, you can see the reasons for why those that are more inclined for stricter monetary policy would want to introduce taper soon. I mean, it looks like we've hit an inflation peak. We covered the latest CPI reading, and we saw it is showing a bit of a deceleration. But who's to say that's to carry on in the next month? We saw an increase in the non-farm payrolls, again, which we covered on this channel. And we saw a reduction in the unemployment rate. So we're meeting the criteria which the FOMC said of significant progress, right? Of substantial progress, sorry. Now, however, on the right-hand side, we can see there's a whole bunch of reasons of why we wouldn't want to taper just yet. You've got the Delta fears still looming, right? We've seen retail figures slowing because of this. We're seeing employment challenges from companies who are having to pay above the odds for workers, and we're still seeing supply chain issues and shortages. So if you're Jerome Powell, where do we sit on this? Where are we going to start tapering? I mean, we've heard some sort of rhetoric around we could see tapering before the end of the year. And my personal belief I've shared on this channel is maybe a September announcement for an October-November start. But some people are saying now, given the factors on the right-hand side in red, which I showed you, the Delta variant, supply chain issues, and retail sales slowing, perhaps it could indeed be delayed to Q1. So that's something for Jerome Powell and his team to thrash out in the Jackson Hole meeting later this week. And we're not sure if we're going to get some clear guidance. My personal belief is they won't say anything. I think they're just going to use this opportunity to further telegraph the idea that it's coming soon. Because Jerome, like I said, Jerome Powell has carefully choreographed this. He said he's going to take a data-led approach, and he's taking his time. He's going to say, yep, it's coming, it's coming, it's coming. He doesn't want to give any investors an excuse to say, oh, we're going to have a tantrum because we didn't see it coming. And that's why a lot of investors are feeling as though we won't see a taper tantrum this year, this time round. Now, let's take a look at what happened in 2013. So if we take a moment, let's see what happened in 2013. So in 2013, after announcement of the tapering, we saw a 5-day increase in yields, right? So yields in 10-year yields went up by 40 basis points, okay? But we also saw, as expected, we saw a 5% drop in the S&P. Now, we need to understand why is this the case, and let's take a minute to make sure we're following why this is the case. If the government is currently purchasing $120 billion worth of assets, okay? And so their asset purchases are, if they're buying, they are increasing the price of bonds, which keeps yields lower. Okay, they're keeping the yields of the bonds lower. So if bond yields are less attractive, just very high level, investors tend to flock to value and growth stocks, right? Equities. If they start reducing purchases, they're buying less as they start to taper, then what you're going to see is and this is what investors are expecting, the price of bonds, as they're buying less, to go down, and thus the yields will go up. And that's what we saw in 2013. The yields went up by 40 basis points, and therefore people thought, hang on a second, you're getting more attractive risk-free returns, risk-free because the government bonds are backed by the government, risk-free, I can get this yield from the bonds, let's move our equities and rotate across to the bonds. And that's what we saw. But what's interesting is what we saw after that. Because in what we saw after that was the S&P rebounded by 5% in the 2 months following the tantrum. And what that was led by was it was led higher by materials, consumer discretionary, and healthcare sectors. So this was interesting. And it's not to say that's going to happen again. Those were the sectors that led that recovery. But it only took a couple of months after this initial taper tantrum for things to really start climbing. And by the end of that year, equities had posted a return of 32%, despite that taper tantrum. Now, I'm of the belief, and a lot of investors are of the belief, we won't see such a taper tantrum this time round. And they feel as though, this is a well-trodden path. Jerome Powell's done a good job of telegraphing his exact movements, and no investors can say they're surprised. And because of that, people feel that these price changes have been built into the markets already. Okay, that's the rationale behind why they feel we won't see a taper tantrum. Now, a few other key indicators we want to be looking out for this week. So that's the monetary policy, and they're going to have to thrash that out at the Jackson Hole Symposium, and hopefully we get some clearer indication or another nudge towards saying, yeah, we're getting closer. Like I said, my belief is September, October, because they've got a few meetings each of these months. Maybe they can announce it then for a November start, and they can start reducing tapering, and they should be done by Q2 next year. Now, remember, they've promised that interest rates will not hike as soon as in line with the tapering. So that helps us understand that perhaps we're looking at end of 2022/early 2023 for our first rate hikes, and even then it's going to be incremental. Okay, so the market should be nice and calm around this. But the only concern is if the markets feel like it's too soon. If we see a deterioration of supply chain shortages, we see another spike in inflation, we see more challenges around employment, then it could be an issue. So the Fed has to be very careful not to say, look, we're going for tapering, and then the Delta situation worsens, and then we're back into a bit of a mess. But like they said, they have said whatever they're doing is not irreversible, which is very true. They could, if they started tapering and then had to repurchase, that's something they can do, but it's not ideal in such a fragile economy. Okay, so the other figures which are coming out are our personal spending figures. So let's see if we can take a look at that. So we're getting some personal spending figures due on Friday. Now, consumer spending is scheduled in July, is expected to go up by 1%. Okay, so we're expecting it went up 1% in June. So what we're expecting so that was in June. So what we're expecting in July is a 0.4% increase. Okay, so we're expecting consumer spending to start decelerating. Okay, so it's still increasing because it's gone up by 0.4%, but it's increasing at a slower rate, similar to what we saw with the inflation figures. Now, we saw last week's figures showed that retail sales had dipped 1.1%, which was more than expected. And we also saw similar troubles here in the UK. And this could be a sign that, look, stimulus is waning, there's less money out there, and the Delta variant concerns have caused an issue. Now, we saw from services spending, there was reports that suggested that at the first 2 weeks of July, spending was really good on services. People were taking out holidays, travel and leisure. But then the second half of the month, it started to fall. And again, that's around Delta concerns, which we have to keep an eye on because that can deteriorate really quickly. Now, the other reading we're going to get is around personal income. Now, personal income, we're just expecting a 0.1% increase, which was the same for July as we saw in June, and also 0.1% increase. Okay, now, so they're the two readings we want to keep an eye on because we saw the consumer sentiment figures come in weak last week when we reported on them. Now we want to see that consumer spending continues to remain strong. We want to see that 0.4% uptick. They're expecting it to decelerate, but if that comes in flat to negative, that could be a concern. And same for the personal income. They just want a slight modest uptick of 0.1%. If that comes in at 0 or negative, that would be another piece of evidence for the FOMC that perhaps tapering is a bit too early. And so that's why they need to take all this data into consideration. That's why the meeting does in fact carry over to Saturday, so they can make they can communicate based on the full set of data they have available. Now, the other interesting concept that we have to think about is if we come out of this picture thinking that inflation is going to be contained, if the markets feel that the Fed has control over inflation and then they're going to reduce tapering and they're going to therefore have a plan in 2023 to keep inflation locked in, then we could potentially, this is something I'm looking at, we could potentially see a rotation out of inflation hedges, which is interesting because we've seen Bitcoin rise, which we could see as a potential inflation hedge. We've seen that just break the $50,000 mark. But could we see a rotation out of hedges? And the normal hedges you see for inflation are your mining stocks, your energy stocks, and banks. Could we see a rotation? That's something I'm looking at. But again, that's a bit more longer term, and we're not sure if inflation is indeed curtailed. We've got to wait for the next CPI reading for that. So there you go, guys. That's the state of the market. We've definitely got a backdrop of volatility again this week. We've got Delta concerns, we've got supply chain concerns still ongoing, we've got the geopolitical concerns around Afghanistan, which is still weighing in on the market with all the concerns it could have around oil and other materials. We've got concerns around the Jackson Hole Symposium, which we've just discussed. Are we going to see an announcement of tapering? Most people expect we're not going to see any announcement. We're going to see more rhetoric to kind of warm people up to the idea of tapering, as if we're not warmed up already. But that's it. That's what we need to have on our minds today. Have a good week, and we'll see you in the next one.